As always, there's a lot of excitement about the budget for us as tax people, and 2026 was no different. I see that a lot of firms have had their budget predictions, their feedback, emails on the budget, and of course the breakfast sessions with the clients to discuss the budget. I have to say, it always surprises me that there's this big focus on the budget rather than the actual changes to the law at the end of the year. But I guess by the time that we get to the end of the year and we've sort of seen the proposals the whole year, they are not that exciting anymore. Be that as it may, now the budget is not only about tax, but today my focus is on the tax aspects in the budget that would be interesting for us as tax professionals and tax practitioners. Thank you for listening to Tax Break, your podcast about South African tax for South African tax professionals and tax practitioners. And in today's episode, it's already episode number 72, I will share a few of my thoughts on items that's in the budget. So in other words, the budget review document that I think are interesting from a tax practitioner or tax professional's perspective. Just to let you know, if you are a regular listener to the episode, to the podcast, I will be out of action for a while, so there won't be new episodes for a few weeks. But don't despair, the podcast has not ended. It's just a temporary break while I recover from a small procedure. A quick reminder as well, as always, if you like the podcast, please rate it on your podcast platform, like it if you can on the platform, and subscribe to the podcast to get a reminder every week when a new episode comes out. And as always, if you want to speak to me, you're more than welcome to send me an email. My email address is in the notes to this episode. Right, so what is in the 2026 budget that I think would be interesting for us as tax practitioners and tax professionals? Now, for the first time in a number of years, we have seen inflation adjustments to the tax bracket. So in other words, no bracket creep. That's good for clients, good for people who pay tax, not so good for academics if you need to now update your questions and your textbook answers for the new tax tables. We have become quite spoiled with there being no changes, but that's tongue-in-cheek. We are all very happy that there is a relief for inflation. I think as far as these inflation adjustments to the tax brackets is concerned, it's the only point to perhaps make is that it seems to only be inflation adjustments for 1 year. So it's not going back for the 3-4 years that we haven't seen anything. Then, second point, as far as the thresholds are concerned, there are a lot of thresholds in the legislation that have not been adjusted for a number of years. And this has been one of the sort of standing points in a lot of the National Treasury consultation sessions that industry has been asking for threshold adjustments. Now, most of these thresholds have been adjusted, and if you look at the table in the budget document, there's a reference to the date when it was last adjusted, and then the new threshold. So it seems as if the intention was to do catch-up adjustments for a number of years that these thresholds were not adjusted. You can obviously now for each one go and do the calculation, compare it to the inflation rate for that period, and you may get to a slightly different answer. But I think the fact is that there are adjustments. They are not only for a single year, unlike the tax brackets. And it includes things like your VAT registration threshold there's been a lot of pressure to increase that for a number of years. So the new VAT registration threshold would be 2.3 million rand. Two things that I want to perhaps mention when we talk about the VAT registration threshold. I think there's already been a lot of questions and comments and ideas as to what does it mean for especially smaller VAT vendors. So I will when I'm back, I'll do a separate episode on things that you need to think about because of this new VAT registration threshold. So should you deregister? What's the effect if you deregister? Those kind of things. The second point is just that these threshold changes are mostly proposed in the draft rates and monetary amounts bill. So as we know from last year with the VAT rate change that was proposed, some things that are in that draft bill can still change, like the VAT rate that didn't increase last year. Somehow, I think that there would be less unhappiness and less resistance to the thresholds being increased. So in all likelihood, we won't see the same happening with these threshold increases. But the fact is, these are only proposals at the moment. There's still a legislative process that needs to happen for these things to be implemented. Then, as far as the, let's call it the hard technical stuff that's normally in the budget, it's my perception, and it may just be me, that that I don't see as many and as complex changes as in many of the other years. So there are not, I don't think there's that many of these changes. I'm going to share a few of the ones that I've picked up that I think could be something to look out for in the next year or so with you. So on SEZ, so entities that operate in special economic zones, there's currently the rule says that if an entity derives more than 20% of its gross income from dealings with connected persons, then that entity is disqualified from the relief that's available to SEZs. It seems like the National Treasury has realized that puts an undue, it disqualifies entities that would, or groups that would choose to have some of their operations in these SEZs that integrate into a larger chain of operations. So the idea or the proposal that's made is that this would be replaced by something that seems a lot like a transfer pricing adjustment. So the requirement would be that these entities would have to deal with their connected persons on an arm's length basis. Then, secondly, there are some changes in the pipeline for collective investment schemes and retail hedge funds. The proposal, it seems, is that all the returns on these investments would be taxed as capital to encourage more people to save. Remember, currently the yield is taxed on a flow-through basis as income. So the yield doesn't become capital when it flows through the portfolio of the collective investment scheme to the investor. Then an interesting one, the National Treasury identified a scheme where it seems that spouses would stagger when they cease to be South African tax residents. So in other words, they would stagger their immigration. Now, the scheme, from what the little bits that's given in the budget document, seems to involve that there's a donation between the spouses, which uses the spousal donations tax exemption, and this donation happens when one spouse has already immigrated and the other one not. So it also seems that the benefit that's derived from this is that the spouse who has not yet immigrated would somehow reduce the capital gains tax on immigration by making these donations to the spouse who has already immigrated. So I don't quite see how that would happen. So if you look at Section 9, capital H, capital B5, the spousal rollover from capital gains tax is not available if you making a disposal to a non-resident spouse. So I'm not quite sure I see exactly how this scheme would work, but it seems that what the Treasury is proposing is that the spousal donations tax exemption would no longer apply if you donate in these circumstances. And this is one of the few changes that would already apply from the date of the budget being published. I don't know if so if you cease being a resident, you don't have any estate or donations tax effect. So I don't quite see why the donations tax exemption would be would be the amendment to this. But let's see what happens. I think if you're dealing with a situation like that, it is worth noting that that it would be affected by the changes. Right, then good news for taxpayers affected by Section 23 Cap N. It's also a topic that one or two of you have asked for a podcast episode on, so there is one in the pipeline. Now, 23N is really, it limits your interest deduction on debts that funded share acquisitions and certain transactions that benefited from certain corporate rules. In 2024, there was an amendment to align the limitation formula in Section 23N with that in Section 23M, which is now a fixed at a rate of 30%. 23N, of course, still has a variable formula that could allow a higher interest deduction. So what the National Treasury indicated in the budget is that they propose to reverse this amendment that was made in 2024. So in other words, Section 23N would then retain the variable formula limitation. Then the next interesting one is the notional input tax from a VAT perspective. So conceptually, that's a vendor who purchases second-hand goods from a non-vendor or from a person who doesn't supply it as a taxable supply is entitled to a notional input tax deduction. There is an exception if the goods are subsequently exported. The full export zero rating doesn't apply. And it seems as if there is something that bothers the Treasury in the sense that some of these goods, because you've got 5 years to claim your input tax, some of the goods are exported fully zero rated before the notional input tax is being claimed, and then the notional input tax is being claimed. So the suggestion that they've got in the solution that they suggest in the budget is that you should only be able, or a vendor should only be able to claim the notional input tax in the transaction period. Now, what is not that clear to me is whether this is only for goods that will be exported subsequently or for all goods subject to notional input tax. My feel, if I look at this, is that it's all goods. The intention is that it might apply to all goods where notional input tax is being claimed. Then, as far as employees' tax is concerned, you may remember that about 2 years ago, there was a change to say that foreign employers with a South African permanent establishment must register as employers for pay-as-you-earn and withhold pay-as-you-earn on the remuneration that they pay. Now, it's been identified that there could be some scenarios that's really an anomaly where you have a foreign company with a South African PE that pays remuneration to a South African resident who's employed in another country, where the idea was never really that the foreign company must then withhold pay-as-you-earn on the remuneration paid to that employee. So this amendment from 2 years ago will be tightened to say that the foreign employer company with a South African PE would be required to withhold employees' tax in respect of employees who are effectively connected to the South African permanent establishment. So it would be narrowed down to say, but if you've got the PE in South Africa, it's only those employees effectively connected to the PE for who you need to withhold employees' tax. Then the last one I want to highlight relates to provisional tax, something that is that a lot of us still need to attend to in the next day or two. Now, what the rule currently says, if you've made an estimate, so you've submitted your IRP6 with an acceptable estimate, but you don't pay the tax, so your estimate is within the acceptable range, but you haven't actually paid the tax, then your penalty that you will pick up would be the late payment penalty, not the underestimation penalty, because your estimate is acceptable. The proposal is that for you to not be subject to the underestimation penalty, you must have submitted an acceptable estimate and paid the tax on that acceptable estimate. If that's not the case, then you would be subject to the underestimation penalty, not the late payment penalty. And the Treasury has indicated that they will look at the interaction between these two penalties to make sure that there's only one of the two. Right, so I think we can say that there are a few things to look out for in the next legislative cycle, and it's always at least interesting for me to see how these proposals transform from the being just proposals in the budget into detailed, often well thought through amendments when it comes to the end of the year and the legislation is amended. As always, I just want to remind you, nothing in this episode was intended to be tax advice or a replacement for tax advice. Until next time, goodbye.